It's a common observation that financial obligations often seem to arrive simultaneously. This phenomenon, where multiple bills become due in a short period, can be understood by examining several interconnected factors related to billing cycles, consumer behavior, and the structure of personal finance. First, let's consider the concept of billing cycles. Most companies that provide services or credit utility providers, credit card companies, mortgage lenders operate on a monthly schedule. These cycles are not centrally coordinated. Each company sets its own schedule based on internal accounting practices. However, many cycles are structured around the beginning or end of the month. For instance, rent or mortgage payments are traditionally due on the 1st. Similarly, many credit card statements close at the end of a calendar month, with the payment due a few weeks later, often around the middle or end of the following month. This natural clustering of due dates around specific points in the calendar contributes to the perception that bills arrive in a concentrated wave. If a person's car loan, student loan, and a major credit card all have due dates in the last week of the month, a significant financial outflow occurs in a very short time frame. Another factor is the alignment of expenses with income schedules. Many individuals are paid on a bi-weekly or monthly basis. This creates specific periods when funds are available. Consequently, people often schedule payments to coincide with these paydays. For example, someone paid on the 15th and 30th of the month might set up automatic payments for various bills to be debited shortly after these dates. While this is a practical cash flow management technique, it reinforces the clustering of payments. The bills aren't necessarily generated at the same time, but their payment is executed in a tight window, creating a feeling of a financial crunch. Human psychology and memory also play a role. This is related to a cognitive bias known as the frequency illusion or the Bode-Meinhof phenomenon. Once a person starts noticing a pattern like several bills arriving at once, they are more likely to see it everywhere. A single month with a particularly heavy concentration of bills can create a lasting impression, making it seem like a constant occurrence, even if other months are more spread out. The stress associated with large financial outflows makes these events more memorable than months where payments are more evenly distributed. We tend to remember the financial pressure of paying 5 bills in 1 week more vividly than a month where those same 5 bills were spread out. Furthermore, the structure of modern life contributes to this effect. An average household manages numerous recurring payments. Housing utilities like electricity, gas, and water communication services, such as internet and mobile phones, multiple subscription services for entertainment, transportation costs, including car payments and insurance, and various forms of debt like credit cards or personal loans. The sheer volume of these obligations increases the statistical probability that several due dates will overlap. As the number of recurring monthly payments grows, the likelihood of a quiet week with no bills due diminishes. Instead, it becomes more probable that multiple payment deadlines will fall within the same few days. Seasonal factors can also influence the timing of expenses. Certain times of the year naturally bring additional costs. For example, the end of the year involves holiday spending, which might lead to higher credit card bills in January. The beginning of a school year can bring tuition payments, school supplies, and activity fees. Property taxes and certain insurance premiums are often due semi-annually or annually, creating large periodic expenses that can coincide with regular monthly bills, amplifying the financial pressure at specific times. If an annual insurance premium is due in the same month as a major holiday, the resulting bills in the following month can be substantial. The initial setup of accounts is another mechanical reason for this clustering. When a person moves into a new home, they typically sign up for all necessary utilities and services within a few days of each other. This means the first billing cycle for electricity, internet, water, and gas will start at roughly the same time. Consequently, the due dates for these services will likely remain grouped together for the entire duration the person lives at that residence. Similarly, when financing a large purchase like a car, related expenses such as insurance and the first loan payment may be initiated concurrently, locking them into a similar payment schedule. From an economic perspective, this bunching of payments can be viewed as a personal cash flow management challenge. Financial education often describes the importance of tracking due dates and creating a budget that accounts for these peaks in expenditure. The use of financial tools, such as spreadsheets or budgeting apps, is a common method for visualizing when bills are due and planning accordingly. These tools help to make the timing of outflows predictable, even if they are clustered. By mapping out all fixed and variable expenses against income, it is possible to anticipate these periods of high financial demand. It is also useful to differentiate between the due date and the billing period. A credit card bill that is due on the 25th of the month covers purchases made in a previous 30-day window, perhaps from the 1st to the 30th of the prior month. The actual spending happened over a month, but the obligation to pay for it is consolidated into a single payment event. When this is multiplied across several credit cards or lines of credit, it creates multiple large, single payments that can fall close to each other, even though the consumption they represent was spread out over time. This temporal gap between consumption and payment concentrates the financial obligation into a specific point in time. In summary, the experience of bills arriving all at once is not an illusion but a tangible outcome of several overlapping systems. The non-coordinated, yet month-centric billing cycles of various companies, combined with personal cash flow strategies tied to pay schedules, create natural clusters of due dates. The sheer number of recurring payments in a modern household increases the statistical likelihood of this overlap. This is further amplified by cognitive biases that make us more aware of these clusters, as well as by seasonal expenses and the way we initiate new services. Understanding these underlying mechanics is the first step in contextualizing this common financial observation. The phenomenon is less a matter of chance and more a predictable consequence of how our financial lives are structured.